Don't listen to the pundits on a day-to-day basis. They're there to get attention, and that's it. No one can consistently determine what's going to happen on a year-to-year basis. If you're like me, back in the day, I would always want to see what analysts and experts were talking about for the upcoming year. What's the right sector to be in? Where should I go? What's going to happen in the economy, etc. And then over time, I started listening to value investors, people like Warren Buffett, Charlie Munger, Howard Marks, Seth Klarman, my friend Gary. They're people like that. These value investors all talk about things a certain way, and they're very consistent. And what I found for me is that what makes the most sense is not caring about all that BS. Why is that? Well, you look at the history of the stock market. So this is the S&P 500 Total Return Index. So this includes all dividends. But I want you guys to look. This is back in 1990. The index was at around 350, 360. It's currently at 8,400. In the last 32 years with dividends, it's up over 20 times the original value in 1990. In that time, what has happened? We've had multiple recessions. We've had a great recession / depression. We've had a pandemic. We've had terrorist attacks. We've had several elections that we didn't know who won. We had so many world issues. We had terrorism all over the world. We had poverty. But guess what? Over the long run, what happened? The world got wealthier. The US got better. The world got better. Everybody's life was lifted up. And therefore, all companies were lifted up. So when you worry about the day-to-day stuff, and when you hear all these projections about what's going to happen, yes, I talk about the S&P 500 being overpriced, but don't confuse that with predicting what's going to happen in the short run. I have no idea. I have no clue what's going to happen this year. No one does. No one can consistently determine what's going to happen on a year-to-year basis. What I like to do as a value investor is look at the world today from where I stand and say, okay, does the next 5 or 10 years look like it's going to be good for investing or bad or somewhere in the middle? As of this very second, I look at valuations. I have my stock market to GDP ratio, which Warren Buffett considers the most accurate measure at any given time of stock market valuations. And based on where we are today, we're 63% overvalued. What does that mean? Is that really bad? Is that okay bad? Well, a lot of people consider .com to be our most overpriced time. So I'm going back to 2000. We were never in the 60s. In the peak of the 2000 bubble, we were never in the 60s. So we're currently today higher than we were in 2000. What does that mean for this year? No clue. What does that mean for the next 10 years? Well, that one we have a little bit better understanding of. To me, it says you just need to be cautious and be ready for a lot of fluctuation and volatility. When we look at history, going back to 1929, the average without dividends is 6.6% return per year in the S&P without dividends. When we're undervalued, the average is 9.3. Makes sense. The less you pay, the more you return. When you're overvalued, the average is 2.3. Also makes sense. The more you pay, the less you earn, right? Now, here's the scary part. When we're 30% overvalued or worse, the average return is negative 0.1%. Now, does that mean stocks are going to go like this? No. And here's why, guys. What's more likely? Think about why people invested in the stock market over the last few years. FOMO. This is what they saw. They saw stocks going like this. So nobody wants to lose out. So they kept buying and buying and buying. Think about it this way. If you had 5 years of this, I already hear people. I was just at a family get-together this weekend, a family gathering. And one of the family members, my wife's niece, said something about an investment. And she said, well, it sure beats my stock market returns, which she's right. The S&P was down 20% last year, not including dividends. That's not great. So imagine if you had years and years and years of flat. You'd say, why should I do that? I can get 4.6% in 98 Treasury. I can get something in real estate. I can do all these things. And that's what causes people to sell off. So what's more likely to happen in the next 10 years is this. Now, does this mean I'm predicting the future? No, I'm just saying this is something that's going to happen over the next 10 years because fundamentals can get better, but it's easier for prices to fall. What I'm telling you is I don't know what's going to happen in 20 or 23. I don't know what's going to happen in 2024. I don't know what's going to happen on any given day, year, month, week. All I know is over the long run, if you expect to get great returns out of the market for the next 10 or 12 years, you'll probably be disappointed. Now, does that mean you should avoid all stocks? Absolutely not. I still want you in the habit of constantly investing in dollar cost averaging. I'm still buying stocks today. And as the stocks go down, I will start to buy more and more stock. But I don't know where it's going to bottom. All I know is if I can buy a company at a price today that makes sense, I am going to do so. Look at, and again, I'm going to talk about an investment I have right now in Alibaba stock. This is not to say you have to do your own research, so don't buy it yourself. But let's look at Alibaba stock. Look at Alibaba. It has fallen a lot from its high of 310. I started buying it. I think my cost base is like 149 or 150. It's currently at 110. So I'm down quite a bit on it. But look, guys, look at the last 6 months. The last 6 months, it's only down about 8 or 9%, right? I don't know what's going to happen here. Look at this. It's almost doubled. Not quite, but it hit a low of $63 back in October. Why would I stop buying it if it made sense? Now, an argument can be made like, well, if stocks go down, it would go down more. True, but my goal is to sit there and buy a company at a great price that makes sense to me. That is my goal, so it can compound on itself. I don't know where stocks are going to bottom, and I don't know where stocks are going to peak. All I know is I look at investment and say, does this make good sense today that factoring in the future and potential for this company, I can make a great return? If the answer is yes, then I buy it. If the price goes lower and my fundamentals stay the same, I buy more. The thing I want you to remember is that you need to be in the habit of never trying to guess. Because the second you try to guess what's going to happen, you're going to end up making mistakes. It's been proven time and time again that the average person who tries to time the market will not do well. You will end up not making as much money as if you just bought and dollar cost average along the way. Because remember, if you've watched our channel before, I show this chart all the time. This is where stock values go, but this is where the price goes. Sometimes you're going to overpay, sometimes you're going to underpay. But if you buy it at equal intervals, you'll end up paying exactly this, and you'll match the market. And remember, matching the market is all you need to do. Because all those mutual funds out there, I've read as low as 2 or 3% over a 10-year period actually beat the stock market. So all these guys making tons of money, charging fees, all these MBAs from Harvard, MIT, all these, they're not able to beat the market. Why? Because they have career risk. There's so many factors in there. I want you to remember that the economy, the stock market is going to do what it's going to do. But I think there's going to be great years ahead for the U.S. economy. And as the U.S. economy gets bigger and better, U.S. stocks will get bigger and better. I want to remind you over and over, from the Great Depression, even if you invest in the stock market at the peak of the Great Depression, you still would have done well. Now, granted, it's 100 years ago, so you wouldn't be around. But the point is that the U.S. economy is resilient and good, and it'll get better. The world economy, as it gets bigger and bigger, the U.S. will take up a smaller piece of that as time goes on. But we want the entire world economy to get better because we will do better along with it. Look at England. We have surpassed England in terms of number one country economy, but they've still done a hell of a great job in the last 200 years since we overtook them, right? In the last 100 years. They still did great. They still do very, very, very well. It's a very wealthy country with great real estate, great economy, great stock market, etc. That's the key here. Don't listen to the pundits on a day-to-day basis. They're there to get attention, and that's it. Listen, you're watching me on YouTube, and I've always said in our 2,000 videos, don't just take my word for it. Go out there and understand it. If it makes sense to you, awesome. If it doesn't, ask more questions. I'm fine with that. But don't just believe somebody because they have a YouTube channel that hit a certain algorithm one day and made it big. Especially, now the thing I like about us is we look at a lot of companies. We talk about a lot of ideas. There's other YouTube channels talk about Tesla. They hit a Tesla video or Tattooed Chef or some garbage company. Go back and watch our videos. Alibaba's at $94.55 today, up 2.5% today. The high here was at 300 and some. That's an incredible difference in the amount of money the stock has been trading at. And if you know me, I love this. The companies that have fallen that we've bought, I keep buying more. That's the difference. The other guys who like Tattoo Chef, Palantir, Workhorse, all these companies, ironically about Palantir, go watch the other videos we have on it, they stopped buying. They had to sell because they only made money if the stock went up. We want to make money. We want to program ourselves to love when a stock goes down. That's the key part here. Love when a stock goes down because you'll be able to buy something that you love for a much cheaper price. And that's what we do here. So guys, not just for 2023, for the rest of your life, program yourself subscribe to this channel, program yourself to stop caring about what the pundits say. Stop caring about what's going to happen at the Fed meeting on Friday. It doesn't matter. The only reason I use those meetings and the only reason I use earnings results from companies on a quarter-to-quarter basis is I want to see people overreact to bad news. That's an opportunity to buy if you have the right company at the right price. And that's what's key there. So guys, subscribe to the channel. And if you watch our other videos and you like our software, we have a risk-free guarantee. Join, and within 30 days, if you don't like it, email us. We will give you your money back, no questions asked. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?